In my hand is a 1976 gold Krugerrand. It contains exactly 1 ounce of pure gold. I bought it on the 15th January 2008. At the time, news had just broke that the Aviva Property Fund had frozen investors' money. To me, this wasn't just a major warning sign of a looming financial crisis. It was a clear signal that trillions of dollars of worry money was about to abandon the stock market and flood into gold. As a result, I took a big chunk of my annual bonus and converted it to gold bullion, enough to support my family for an entire year if everything collapsed. You know what happened next. On the 15th of September 2008, Lehman Brothers declared bankruptcy. Governments around the world embarked on a printing spree north of $12 trillion to prop up an ailing financial system. And the price of this gold coin rose from the $600 I bought it for to more than $1,900 in the space of just 4 years. I'm speaking to you today because every signal I'm watching is once again pointing to another spectacular run-up in the price of gold. And I want to do everything in my power to help you profit from it. The past few months have shown us what this market is capable of. After years of sideways price action, gold has broken out to brand new all-time highs. It's currently sitting at just under $3,000 an ounce. It's trounced the FTSE. It's beaten the tech-heavy NASDAQ. In fact, it's on course to have its best year since the 1970s. Now, to the casual investor, it's easy to see that move and think gold has no more room to run, that all the gains have already been swiped off the table. But as someone who's designed gold investing strategies for central banks and elite institutions like Goldman Sachs and Morgan Stanley, as someone who got into gold in 2007, right at the start of the last bull market, I can tell you, I believe what we're seeing right now are simply the early stages of a far larger boom. My own analysis tells me gold's next stop is $10,000 per ounce. And by the standards of the world's foremost gold experts, that's a conservative estimate. Wall Street investment firm Göring and Rosenzweig have forecast gold will one day hit between $12,000 to $15,000 an ounce. Former investment banker and CIA analyst Jim Rickards believes gold could blow past $27,000. While Peter Schiff, the renowned forecaster and founder of investment firm Euro-Pacific Capital, believes gold is headed to $100,000. Now, if you've been following along the Southbank Gold Summit 2025 so far, you're already aware of all of this. You already know that central banks are buying up gold at rates never seen before, that demand in India and China, the world's 2 largest markets for gold, is at near-decade highs, and that in October, U.S. retail giant Costco sold out of gold in 77% of its stores. But my sense is that you don't simply want to be informed about the forces sending gold higher. You don't just want to watch as gold soars past all-time high after all-time high. You want to get in on the action. So, the simple question is, what steps can you take to reap maximum possible reward from a new gold boom? Well, before you start buying up gold sovereigns, Krugerrands, and jewelry, know this. I am not here merely to show you how to profit from physical gold as it increases in value. I want to do more than that, and I hope you want to do more too. Over the next few minutes, I'm going to introduce you to a small portfolio of stocks with built-in leverage to the gold price. For every $1 rise in the price of gold, these stocks could each rise 10, even 20 times higher. That's what happened the last time we saw a setup playing out like this. In fact, during the gold bull of the 2000s, the price of physical gold rose 6-fold. But a gold miner by the name of Kinross Gold made a 1,327% gain, more than double gold's return. In 2016, the physical gold price took off again, doubling from $1,000 to $2,000 in the space of just 4 years. But at the same time, K92 mining soared up 580%. Fast forward to today, and while gold is up 30% year over year, core mining is up 5 times that at 150%. Now, It's right to say that these are some of the best performers. Not every gold stock performs this way. My aim is to help you ride the biggest moves just like these right to their peak. But why should you even care about what I think or which stocks I'm predicting to make big returns in the gold market? The fact is, I've been immersed in this market for more than 2 decades. I first started covering gold more than 20 years ago in my role as head of debt strategy for one of the largest investment banks in Germany. In fact, in 2003, when gold was in the very early stages of an epic bull market, I released this report to my institutional clients. In it, I predicted the price of gold would rise to levels not seen for years. It was back in 2003 that I first started accumulating the yellow metal myself, before making that big investment with my own personal wealth ahead of the great financial crisis. Now, as you can probably tell from my accent, I'm not German, nor am I British. I originally hail from San Francisco. But my work in financial markets has taken me across the globe, from New York to Frankfurt's Bankenviertel, and ultimately to the City of London, where I served as managing director of 2 of the largest investment banks on the planet. It was right here in London in 2005 when Institutional Investor magazine ranked me the #1 investment strategist in Europe. And that was due in large part to my work on gold. Throughout my time in the industry, I've had private meetings with some of the most powerful players in the business. People like Pierre Lassonde, former chairman of Newmont, the world's largest mining corporation, and Peter Hambro, former managing director of another former mining giant, Petropavlovsk. I've also written 2 top-selling books on the subject. The Golden Revolution, which I wrote in 2012, has been cited numerous times in major publications, and has been widely praised by many of the world's foremost gold experts. Summit speaker Jim Rickards called it an indispensable reference on the subject of gold as money, while Peter Schiff called it a necessary light to keep you headed in the right direction. I followed up in 2017 with The Golden Revolution Revisited, currently rated 4.5 stars on Amazon. My deep analysis in those books has earned me invitations to speak at some of the most important gold investing events in the industry, such as Mines and Money in London and the Sydney Gold Symposium. Bottom line, I know a gold bull market when I see one. I know exactly how they play out. I know how to make money from them. And let me tell you, I have never in my life been as bullish about the situation playing out in the gold market as I am right now. And it appears I'm not the only one. Stanley Druckenmiller, George Soros's former right-hand man, is selling his holdings of Amazon, Alphabet, and Alibaba. And in its place, buying up over $50 million worth of gold mining stocks. Ray Dalio, founder of the world's largest hedge fund, has added gold to his personal investment portfolio. Billionaire investor David Einhorn has bought $74 million worth of exposure to gold through his hedge fund Greenlight Capital. Paul Tudor Jones, renowned as one of the most successful hedge fund managers in history, has told interviewers at CNBC that he's long gold. Make no mistake, these guys aren't investing in the yellow metal on a whim. They're positioning themselves ahead of something big brewing in the gold market. And today, you can position your money ahead too. But I must make you aware, if you want to make as much money as possible from the coming run-up in gold, there's simply no time to waste. Fact is, this market is just beginning to take off. Gold Explorer Moss & Gold is up 204% this year. Australian gold miner Ora Banda Mining is up 373%. Canadian gold producer Founders Metals is up 381%. Again, these are some of the market's best performers so far, and while past performance isn't indicative of future returns, these examples show you the outsized potential this market has to offer. I fully expect a lot of investors to see the money already being made in this market and to simply stand on the sidelines. They'll watch on as other investors position themselves for potential profits, and they'll let this opportunity pass them by. Then there will be those who possess the decisiveness required to hunt for gains from what's playing out in the gold market right now. If I've pegged you right, you fall into the second category. You've already done the hard work. You've looked into ways to profit from this situation. You've taken the time to sign up to our Southbank Gold Summit 2025. You've already heard from the experts we brought together to share their inside intelligence on the gold market. Now, I'm going to make it incredibly simple for you to take the final step. If you want the chance to make 2025 the best year of your financial life, all you have to do is stay right here. In just a moment, I'm going to share details of my top 3 stocks I believe are best placed to take advantage of the rising gold price. But first, I want to leave you in zero doubt about what happens during the next phase of this gold boom. Because as I speak, a convergence of 3 unstoppable forces is conspiring that could send the price of gold vertical. Let's run through them now. Unstoppable force number 1, the Cobra Effect. To explain the first unstoppable force, I need to take you back to 19th century British-controlled Delhi in India. Picture the scene. The streets of Delhi teemed with life. Market vendors called out their wares. The air hung thick with spices. But beneath this bustling facade of colonial life, a deadly problem was slithering through the city streets. Because at the time, colonial officials in Delhi faced a deadly crisis. Their city was overrun with venomous cobras. Their solution seemed perfectly logical: offer a generous bounty for every dead cobra brought to their offices. At first, it worked exactly as planned. Dead cobras poured in by the hundreds. The officials congratulated themselves on their clever solution. Until they discovered something that made their blood run cold. Enterprising locals had started breeding cobras in their homes. The very incentive designed to solve the problem was now making it exponentially worse. When officials frantically canceled the bounty program, those cobra breeders did the only logical thing. They released their now worthless snakes into the streets. Delhi ended up with more cobras than when they started. This story came to epitomize a principle known as the Cobra Effect. The idea that government policymaking can often have hugely consequential and unintended second-order effects. And I'm here to tell you that one of these devastating Cobra effects is playing out right now. It's triggered an unstoppable chain reaction across the financial system and sent the world's most powerful investors rushing into gold at a pace we haven't seen in half a century. Who are these investors exactly? I'm talking about central banks. You've no doubt heard of the sanctions the West has imposed on Russia as a result of its invasion of Ukraine. But there's one specific action the US and its allies have taken that's challenged the very makeup of our financial system. They froze over $300 billion worth of Russia's US foreign currency reserves, seized them, and then used those frozen assets to back a massive aid package to Ukraine. And that has meant, for any nation not firmly in the Western alliance, a stark reality has emerged. Your US dollar reserves, long considered the world's safest assets, are only as secure as your relationship with Washington. The result? Central banks across the world are dumping their dollars in favor of the greatest financial insurance policy known to man, gold. In fact, after decades of being net sellers of gold, central banks are now buying gold at the greatest rate since the 1970s. Who's buying? Well, it's probably no surprise that Russia is leading the charge. In the wake of the sanctions, Russia began buying $54 million worth of gold every single day. That means that Russia's gold reserves recently exceeded $200 billion for the first time in history. And its share of gold amongst other currency reserves is the highest it has been this century. Then there's China. It is in the midst of what internationalbanker.com calls a gold buying frenzy. It's reeling off the back of purchasing gold for 17 months in a row. In fact, it has purchased 2,800 tons of the stuff, more than all the metal backing ETFs around the world, and more gold than it has purchased the last 50 years. As my friend Ross Norman, chief executive of metals.daily.com, states, the flow of gold to China has gone from solid to an absolute torrent. But remarkably, neither China nor Russia are the largest buyers. In fact, it's India. Earlier this year, India set in motion an operation to move 100 tons of its gold from the United Kingdom back to Mumbai. The Thai central bank has doubled its gold reserves to $15.6 billion. The Turkish central bank has bought gold for 12 straight months. And then you've got Saudi Arabia. Summit speaker and analyst at Money Metals, Jan Nieuwenhuis, recently exposed the Saudi Arabian central bank covertly buying 160 tons of gold. And it's not just America's adversaries dumping US dollars in favor of gold. The Bank of England has recently become a net importer of gold once again. Poland just bought 130 tons of the stuff, increasing its holding by 57%. The Czech Republic has increased its holdings by 32 tons, a 141% increase. Hungary has added 107 tons, which is, get this, a 3,376% increase. Heck, even the European Central Bank became a net importer of gold in 2023. Please understand, central banks around the world aren't buying up gold to make a quick buck from a few months down the road. They're buying because a major structural change has occurred in global financial markets. What we're seeing here is a landmark reversal of a 40-year megatrend. The chart on your screen right now illustrates that perfectly. A shift of trillions of dollars in capital out of the dollar and into gold. As you can see, from 1980 right up until 2022, gold's share of global international reserves plummeted from 65% to around 10%. But that trend is now unwinding. This is why analysts at ANZ Bank said they expect central bank purchases to remain hot for the next 6 years. It's why central bankers from Mexico, Mongolia, and the Czech Republic recently announced they're likely to increase their country's reserves in the years ahead. Given the context that we are facing right now, the share of gold in our portfolios could be increasing as well. In Mongolia's case, I expect that the reserves will continue to grow, and I also expect that the share of gold in our reserves will likely increase in the future. It's why just last month, India made its biggest increase in gold purchases since 2009. And it's why Russia announced in September that it planned to increase its gold buying by 600%. In fact, right now, many gold experts are speculating that simply buying gold could be just the start of their plans. They believe we are now watching the first stage of a plan to move away from the dollar and establish an alternate gold-backed currency. Now, I'm well aware that gold bugs have been saying that there will be a return to the gold standard since Richard Nixon ended it in 1971. But for the first time in decades, this now appears to be a serious possibility. What you're looking at right now is something called the unit. It is a prototype banknote of a new currency, one which Vladimir Putin recently unveiled at the 2024 BRICS conference. Now, you might have heard of the BRICS before. This term first gained traction in the early 2000s to describe 4 emerging economies, namely Brazil, Russia, India, and China. But that moniker has now morphed into an intergovernmental organization that includes many U.S. adversaries, countries such as Iran, Egypt, the United Arab Emirates, Ethiopia, Cuba, Kazakhstan, Uzbekistan, and a host of others. In fact, together, they now account for more global trade than all of the G7 countries put together. And given the hostile economic environment that many of their members are now facing, they are now plowing full steam ahead with a plan to create an alternate currency other than the US dollar to transact with each other. And here's the thing, that currency is going to be backed by gold. According to a recent announcement from New Development Bank President Dilma Rousseff, there is an agreement in principle for the unit to be backed 40% by gold and 60% by local currencies. There's no doubt about it. Should this come to pass, BRICS countries would be required to kick their gold buying up to an even higher gear, adding rocket fuel to an already soaring gold price. In a moment, I'm going to give you exact steps to potentially profit from central banks' insatiable demand for gold. But first, I want to tell you about the second force driving gold higher. Unstoppable Force 2, Return of the Money Printers. To illustrate the second force sending gold higher, there's only one chart you need to see. On your screen right now is a chart from the Office for National Statistics. It shows the purchasing power of the British pound over time. In the last 50 years, the pound has lost 87% of its value. Let me put that into perspective. In 1971, 1,000 pounds would have bought you a brand new Ford Cortina. Today, that same 1,000 pounds wouldn't even cover the cost of the car's windscreen. Of course, I don't have to tell you this. In recent years, this destruction of our purchasing power has accelerated at a frightening pace. The average family's energy bill has exploded from 1,042 pounds in 2020 to 2,500 pounds today. A basic weekly grocery shop that cost 60 pounds in 2020 now sets you back over 90 pounds. Even a morning coffee that cost £2.50 before the pandemic now costs nearly £4. Train ticket prices have shot up 40% in just 3 years. Now, politicians love to blame this on anything else but the actual cause. They'll say it's because of supply chain issues, or the war in Ukraine, or corporate greed. But these are in large part just excuses. The prime driver behind all of this is one thing: money printing. Simply put, by increasing the money supply and slashing interest rates, governments increase the amount of money in the economy. The knock-on effect is more money chasing the same amount of goods and services, which in turn causes the price of goods and services to rise. It's the classic definition of inflation. This has two major impacts. First, it means the pound in your pocket no longer goes as far as it used to. Your wealth is effectively being eroded. Second, it transfers that wealth into the hands of those creating the money: governments. As Nobel Prize winning economist Milton Friedman said, "Inflation is taxation without legislation." Renowned free market economist Thomas Sowell echoes these same sentiments. He says inflation is a way to take people's wealth from them without having to openly raise taxes. Yet inflation is the most universal tax of all. And even John Maynard Keynes, the man largely responsible for the economic regime we live in today, agrees. He said, by a continuing process of inflation, government can confiscate, secretly and unobserved, an important part of the wealth of their citizens. Of course, inflating away the value of citizens' currency through money printing isn't new. The Romans gradually reduced the silver content in their denarius from 97% to just 0.5% until their coins became literally worthless. The Spanish Empire flooded Europe with so much New World silver that it destroyed their own economy. The Chinese Ming Dynasty printed so much paper money that farmers refused to sell their rice for it. Our leaders of today are merely repeating the same pattern played out by every major empire in history. And if you think that pattern is going to magically cease, you've got another thing coming. Because after a brief pause, all signs point to a return to an era of cheap money and wealth destruction. Case in point, the European Central Bank has issued back-to-back interest rate cuts, bringing the rate down from 4.5% to 3.4%. The U.S. Federal Reserve has also implemented back-to-back rate cuts, as has the Bank of England. Canada has cut its interest rate 4 times in the last year. China has implemented 4 interest rate cuts. In fact, no less than 12 major central banks worldwide are entering rate-cutting cycles. What's more, while central banks are lowering interest rates, governments are once again spending money like their lives depend on it. You only have to look at the new Labour government to see that. Off the back of £8 billion in pay rises to train drivers, Chancellor Rachel Reeves has unveiled £380 billion in spending aimed at putting more pounds in people's pockets. The government's spending plans exceed their ability to fund them through current means. According to the Office for Budget Responsibility, this will lead to a doubling of government borrowing. On top of that, to accommodate these extensive spending plans, Reeves has taken the extraordinary step of changing the very rules designed to keep government borrowing in check, essentially moving the goalposts when spending exceeds the safety limits. As Money Week reported in October, Rachel Reeves has confirmed she will change the UK's fiscal rules in her budget next week, which will free up billions of pounds for infrastructure spending. The upshot of all this is government spending at a rate never seen before, and the UK isn't alone. The EU has just unlocked €392 billion to allocate towards military spending, and that's along with £500 billion more to spend as part of its COVID recovery fund. India is increasing its capital expenditure by 33%. It's due to spend approximately $118 billion to stimulate economic growth. Ireland has announced an additional €8.3 billion in its budget. Nigeria plans to spend an additional $28 billion. Russia's defense budget has increased by 30%. Germany is also looking likely to be loosening its purse strings once again, too. After its coalition government collapsed in November, markets are now pricing in a victory for the Christian Democrat Union, who have hinted at more government spending in the future. And then there's the big kahuna, China. With its economy on the ropes, China has just announced a colossal $839 billion spending plan over the next 3 years to help local governments refinance their hidden debts and boost the slowing economy. It doesn't take a genius to work out the inevitable result, a savaging of currencies all across the world. This isn't guesswork. The Treasury recently admitted that in the lead-up to Rachel Reeves' budget, she sought advice from leading city figures. Her goal? To guard against a Liz Truss-style meltdown of the UK bond market, and in turn, the pound. In fact, with inflation ticking up once again, we've already started to see the effects of this filter through the economy. The good news is, situations like these are precisely what gold is meant for. Unlike every single government-backed currency, you cannot print gold into existence. It cannot be diluted, and it cannot be manipulated. This is why, as the value of currencies around the world has been decimated over the past 50 years, gold has done this. If you want to help protect your wealth from nuclear-powered money printing, then gold is the logical and smart choice. I really hope you are beginning to see the sheer size and scale of the opportunity in front of you right now. Because as governments continue to destroy trust in their own currencies, and as central banks continue to pile into the market, I believe it's obvious that gold will continue to hit all-time high after all-time high. In just a second, I'm going to reveal to you my private plan for making a fortune from this situation. I'm going to give you the key details of 3 gold stocks with natural, built-in leverage to the gold price. For every dollar rise in the price of gold, these could rise far more. But first, I need to tell you about the final force driving gold higher. Unstoppable Force 3, the global powder keg. There's an old saying in financial markets, in times of crisis, money moves. But that phrase is missing 2 crucial words in my view. The full truth should be this. In times of crisis, money moves into gold. You see, there's a reason why gold has earned the title of the ultimate safe haven. Its independence from governments, finite supply, and physical nature have preserved wealth through countless wars and economic collapses. Which brings me to a sobering reality. The world today is more dangerous and loaded with more risk than at any time in the past 70 years. Look around. Russia's ongoing war in Ukraine is escalating by the day. China is looking increasingly more likely to wage war on Taiwan. North Korea continues missile tests with nuclear ambitions, threatening South Korea, Japan, and even U.S. territories. Iran is nearing nuclear weapons capability, increasing the likelihood of a preemptive strike by Israel or its allies. India and Pakistan remain locked in a decades-long conflict over Kashmir, both nations possessing nuclear weapons. The Arctic has become a new battleground for territorial claims as Russia militarizes the region. Global arms races are escalating, with hypersonic missile systems making traditional defenses obsolete. Proxy wars are spreading in the likes of Yemen, Libya, and Syria as global powers compete for influence in Africa and the Middle East. Turkey's aggressive posturing in the eastern Mediterranean over gas reserves has sparked tensions with Greece and NATO. Energy infrastructure is coming under attack. The U.S. is more politically divided than it has ever been, with trust in its institutions at an all-time low. Developing nations are struggling to service their debts, increasing the risk of widespread defaults. China's property sector crisis could trigger a global financial contagion. Think of the world right now as a room filled with gas. Not just a leak from one pipe, but gas seeping in from dozens of sources. Each crisis I've mentioned is adding more fuel to that room. And all it takes is one spark, one miscalculation, one desperate act, one wrong move to ignite the whole thing and send an exodus of money out of global financial markets and into gold. I hope you are beginning to understand the scale of the opportunity you're faced with today. You've seen how central banks are bidding up the price of the yellow metal at rates never before seen. How governments are once again unleashing cheap, easy money into the economy. And how, with two land conflicts in Ukraine and the Middle East that could escalate any minute, along with talk of major recession in China, the US, the Eurozone, and right here in the UK, I believe it's not a matter of if people are on the cusp of turning to history's greatest financial insurance policy en masse, it's a matter of when they begin to drive the price of gold past $10,000 over the coming years. And crucially, what to buy to take maximum financial advantage of this colossal wealth shift, even as others see their own finances decimated. And that's why I'm speaking to you today. Because when gold is in the ascendancy, when the danger signs I've shown you are flashing red, history has proven that time and time again, one type of stock rules the market. A type of stock that's capable of multiplying your wealth many times over. The supply kings. Look, owning hold in your hand gold is a great way to benefit from booming prices, no question, and it's a great means of wealth protection in turbulent times. By now, I think you agree with that. But I want to take things up a level for you, and that means using a small amount of risk capital, that's money you can't afford to lose, on the gold investments that have the potential to shoot the absolute highest during gold booms. And I'm talking about gold miners. Believe me, owning the right miners in a gold boom can be outrageously profitable. That's why I call them supply kings, because in the right conditions, gold producers can reign supreme. Yes, it's great to own the physical stuff, without a doubt. But when gold miners begin to take off during gold booms, you can amplify the gains that physical gold makes you many times over. For example, take the iconic gold bull of the 1970s. In 1979, the price of gold more than doubled. But had you diversified into a portfolio of gold miners, just look at how much money you would have made. On average, 2,313%, more than 10 times the return on gold itself. Those are insane returns, and as clear a sign as any that if you're gunning for maximum gains in a gold bull market, the best way to play it is by investing in gold miners. But as amazing as these returns sound, please know Winning big from a gold boom is not as easy as just buying any mining stock and watching it soar. You need to understand how gold bull markets truly work and when these monster profits are most likely to occur. You see, every major gold bull market in modern history follows a very specific pattern, one that unfolds in two distinct phases. Let me explain. In phase one, institutional money, the kind controlled by central banks, sovereign wealth funds, and major financial institutions, floods into physical gold. This drives the price of gold dramatically higher, just like we're seeing right now. But here's the fascinating part. During this first phase, gold mining stocks don't tend to make anywhere near the blockbuster moves I just showed you. Let me show you what I mean. Take a look at this chart from the iconic gold bull market of the 1970s. The gold line you're seeing is the price of gold itself. As you can see, it's moving steadily higher, exactly what you'd expect in a bull market. But now look at the gray line. This is the Barron's Gold Mining Index, tracking the performance of the largest gold miners at the time. Notice something strange. Despite gold marching higher and higher, the mining stocks are barely keeping pace. There's none of those astronomical 1,000% plus returns I showed you earlier. In fact, for much of this period, these mining stocks were actually underperforming the metal itself. This is what I call phase one of every gold bull market. And it makes perfect sense when you think about it. When people first sense trouble in the financial system, when they first start to worry about their currencies being devalued, physical gold is the natural first move. It's the most logical place to park your money, the safest way to play the trend. But then something interesting happens. As the price of gold moves higher and higher, investors grow more confident in the trend. They see the profits being made, and naturally they start hunting for ways to make even bigger returns. They start moving along the risk curve, and that's when they discover gold mining stocks, when phase two of a gold bull market begins. They're easy to spot after the fact because that's when the price of gold mining stocks does this. As you can see, months after the price of gold has begun to rise, that's when gold miners began to absolutely take off. Just look at that gray line shoot vertical. This is what happens when the flood of investors, now confident in gold's upward trend, start piling into mining stocks. We saw exactly the same thing happen in the gold bull market of the late 2000s. As you can see, in the early stage of the bull market, gold and miners were neck and neck. But then, gold miners, those with proven reserves cashing in on their new fat margins, started reporting on the insane profits they'd been making. And that's when phase two began in earnest. Gold continued to make fantastic returns, more than doubling. But gold miners blew those returns completely out of the water, more than tripling between October 2008 and September 2011. That begs the question, where are we now in the current bull market? To tell you everything you need to know, you only need to look at this chart. What you're looking at is the valuation of gold mining stocks compared to the price of gold itself. And it tells an extraordinary story. As you can see, up until very recently, gold miners have been trading at their lowest valuations in over 2 decades. They've been completely ignored by the market, despite gold breaking out to all-time highs. But look closely at the far right of that chart. Mining stocks are just starting to tick up. This is absolutely crucial to understand, because right now, I believe you have the rare opportunity to do something that hardly any investor ever gets to do. Buy into a market just before it begins to boom. Frankly, as investors, we are very lucky to have this rare convergence of events fall into our laps. Not only are central banks ramping up their purchases of gold, driving unprecedented demand for the precious metal. Not only are governments around the world devaluing their currencies, putting more and more upward pressure on the price of gold, but proven gold producers are in the cusp of posting blockbuster profits, igniting the second phase of the gold bull market. Now is your chance to stake your claim and reap maximum profit from the situation. But the question remains, which gold stocks do I buy? You see, when it comes to deciding which stocks to buy to ensure I only pick the cream of the crop, I've developed my own checklist. A gold miner must meet every criteria on this checklist for it to be added to my buy list. Checkbox number 1. Operations in politically stable jurisdictions with a narrow geographical focus. The mines must be located in countries with strong rule of law, clear mining regulations, and low risk of political disruption. Additionally, having mines concentrated in only a few regions reduces operational complexity and management overhead, leading to better cost control, and ultimately more profits for us as investors. Checkbox number 2. Strong institutional ownership. Having significant backing from institutional investors is a powerful validation of a company's potential. These institutions manage billions of dollars and employ teams of specialized analysts to conduct exhaustive due diligence, effectively doing the heavy lifting of separating the wheat from the chaff. When multiple institutions are building significant positions in a mining company, it serves as a valuable sanity check on your own investment thesis. Checkbox number 3, high quality ore grade. The higher the grade, grams of gold per ton of ore, the more economical the operation. High grade deposits mean less ore needs to be processed to produce the same amount of gold, resulting in lower processing costs, less energy consumption, and a smaller environmental footprint. This directly impacts profit margins and makes the operation more resilient during price downturns. Checkbox number 4, low debt and a good debt plan. Miners always acquire at least some debt. I need to know how much and what they plan to do with it. Now, I am pleased to inform you that I have uncovered the ideal gold miner, one that ticks each of these boxes with flying colors. So, let's look at how this ideal gold mining stock, what I believe could be the single best way to play the gold boom of 2025, stacks up against my criteria. First up, political stability. Unlike so many miners gambling their futures in unstable regions, this company has masterfully positioned 70% of its production in the Americas. In today's uncertain world, that's pure gold in itself. Next, institutional backing. When I dug into the ownership structure, what I found stopped me in my tracks. A staggering 71% of shares are held by institutional heavyweights. We're talking Van Eck, Vanguard, and BlackRock Group. These titans don't deploy billions without exhaustive due diligence. Their massive stake tells you everything you need to know about this company's quality. High-grade ore. This is where it gets really interesting. Their two flagship projects, strategically positioned in Canada and Alaska, aren't just good, they're exceptional. The ore grades at both sites absolutely dwarf what's being processed at the Fort Knox Mill, one of the largest gold processors in North America. In the mining world, grade is king, and these deposits are wearing the crown. The debt position. Now, any serious mining operation requires capital, but here's what sets this company apart. They're sitting on $2 billion of liquidity, including $465 million in cash. Yes, they do have $800 million in debt, but they've mapped out a crystal clear path to wipe it clean by 2025. With gold prices where they are now, that's looking to me like an absolute certainty. This is exactly the kind of opportunity I've been hunting for. A rock-solid mining operation with best-in-class assets, institutional backing, and a history of exceeding expectations, all perfectly positioned to capitalize on the coming gold boom. Now, it's fair to say investing in this type of gold mining stock is riskier than investing in physical gold itself. And that greater risk also results in greater potential for reward. But it's important to remember that should you decide to invest in such stocks, that your money is at risk. Only ever invest what you can afford to lose. You can learn everything you need to know about this stock in a special report I've put together called 3 Essential Stocks for Your Precious Metals Portfolio. Inside, I do an even deeper dive on the ideal gold miner and why I believe it's set to be one of the blockbuster mining stocks of this gold bull market. You'll learn its name, its ticker symbol, and detailed instructions on how to buy it. I'll show you how to get your hands on this report in just a second. But first, I want to tell you about the second stock I want to send your way. I want to tell you about my gold skimming play. The next stock I want to share with you may come as a surprise. It's not a miner, it's not an ETF, and it's certainly not tied to any obscure type of gold bullion. Instead, it's built around an incredibly smart business model, one that most investors have never even heard of. I'm talking about gold royalty companies. See, when most people think about making money from gold mining, they picture the companies doing the actual mining, the ones spending billions on equipment, hiring thousands of workers, and dealing with endless permits and regulations. But royalty companies work differently. Instead of mining gold themselves, they essentially skim profits from the gold industry in a brilliant way. They provide funding to a host of different mining companies. In exchange, they get the right to purchase the gold produced at a heavily discounted fixed price, often for the entire life of those mines. Think about how brilliant this is. These companies operate with minimal overhead, often just a handful of employees in a small office. They have zero operating costs to worry about, no expensive equipment to maintain, no workers to manage. But there are 2 things that make this business model truly special. First, as I mentioned, they lock in incredibly low purchase prices for their gold. When gold prices rise, as they are now, that means they're enjoying profit margins that most businesses can only dream of. And if gold hits $10,000 like I expect, those margins will become absolutely astronomical. Second, and this is crucial, they've found a way to virtually eliminate the biggest risk in gold mining. You see, they let the mining companies handle all of the operational risk and expense. They're the ones buying the equipment, hiring the workers, dealing with permits, and hoping they find enough gold to make it worthwhile. Take Franco-Nevada, one of the largest royalty companies on the market. They have 118 producing mines in their portfolio. If one mine runs into problems and stops producing, they still have 117 others bringing in money. That kind of diversification is simply impossible to achieve with traditional mining stocks. And that approach has translated into serious stock market returns. As you can see, while gold itself has performed admirably, Franco-Nevada has absolutely crushed it, delivering more than 5 times the returns of the metal itself. And it's not the only mining company that's delivered serious returns for its investors. Royal Gold, another top 5 gold royalty company, is up more than 7,000% since the year 2000. But here's what's really exciting. I've identified what I believe could be the #1 gold royalty company in the world right now. While companies like Franco-Nevada and Royal Gold pioneered this business model, I believe this company has perfected it. Let me explain why. First, they've built their business on an incredibly solid foundation. A staggering 93.4% of their current production comes from mines in the bottom half of the cost curve. What does that mean? When a mine sits in the bottom half of the cost curve, it can typically produce gold profitably even when prices fall to $900 or below. This ensures steady, reliable cash flow no matter what happens in the broader market. Second, and this is particularly telling, Institutional investors own 63% of this company. When the smartest money in the world, the kind that has armies of analysts at its disposal, takes such a large position in a company, it's usually a testament to the outsized potential. Third, they've structured their business to capture maximum profits. They've locked in some of the most attractive purchase prices possible. We're talking about operating margins between 75 and 80%, amongst the highest in the entire mining sector. To put that in perspective, for every 1 million pounds worth of gold they produce, they keep 800,000 pounds as pure profit. That's the kind of margin most businesses can only dream about. You can learn everything you need to know about this remarkable company in my special report, 3 Essential Stocks for Your Precious Metals Portfolio. I want to hand you this report as soon as possible. But, and forgive my frankness, I have spent too much time researching this opportunity to simply give these companies away in an open forum. I'd like to give you this report in a much more discreet way. By introducing the Fleet Street Letter, I'm willing to send you this free report right away if you're willing to take up a no-obligation trial to my monthly newsletter, the Fleet Street Letter. This is a way I can talk to you behind closed doors and exchange my valuable report privately. There's no pressure to continue beyond your trial. You are free to take a look around, download your urgent gold investing report, and see the other opportunities in my exclusive Fleet Street Letter portfolio. Let me share a little about our methods. Here at the Fleet Street Letter, we focus on something I like to call deep change. This is very different to the way most so-called experts look at the world. Read most mainstream financial commentators' work and you'll see it's packed with superficial and often downright wrong analysis. I'm sure you know the kind of thing I'm talking about. The markets will go up in September. Get out of Tesla. It's going down this week. It's all nonsense. It's all superficial change. And it's all entirely impossible and therefore futile to try and predict. Deep change is different. It's shaped by the big, powerful forces or trends that nobody can control and 999 out of 1,000 people don't even see. It's based on demographic, political, economic, and environmental trends. The slow-moving but intensely powerful forces that impact everything and everyone. The Fleet Street Letter isn't just about the forces shaping the gold market. It's about the forces shaping all of financial markets. Let me share a little about our methods. The Fleet Street Letter was founded by a remarkable British intelligence agent named Patrick Maitland. In the 1930s, Maitland began as a special correspondent for the Times before being recruited into the political intelligence department at the Foreign Office. His career reads like a spy novel, surviving 3 assassination attempts, evading the Romanian Iron Guard during World War II, and escaping Albania as Italian forces invaded. But alongside his work for King and Country, Maitland lived a double life. He operated a private intelligence network through an independent organization he called the Fleet Street Letter. It was this network that enabled him to make such extraordinary predictions. In 1938, while most of Britain still clung to hopes of peace, Maitland's intelligence sources helped him to see the truth. He warned subscribers that war was inevitable, even predicting its timing. Herr Hitler would like to postpone a conflict for another 6 months or until September. This warning, still preserved in the British Library, of course proved tragically accurate when German tanks rolled into Poland on September 1st, 1939. This tradition of prescient warnings continued through the decades. In 1987, when most investors were caught completely off guard by Black Monday, one of the most devastating market crashes in history, the Fleet Street Letter readers had been alerted to the danger 5 months in advance. In 1997, 2 of our most celebrated experts, Lord William Rees-Mogg, former editor of the Times and father of former MP Jacob Rees-Mogg, and James Dale Davidson, a close confidant of Bill Clinton, published The Sovereign Individual. In it, they predicted a new digital form of money of encrypted sequences, unique, anonymous, and verifiable, effectively describing Bitcoin over a decade before its invention. This prescient work so profoundly influenced PayPal founder Peter Thiel that he calls it his most influential book. Our track record of foresight continued into the new millennium. On the exact day the Nasdaq began its devastating 77% decline in 2000, we warned subscribers that a day of reckoning was at hand for the dot-com boom. Of course, we don't have a crystal ball. Not all of our predictions are correct. 8 years later, we alerted readers that the city's dream run is about to end, and it could trigger our worst recession in 35 years. Just 5.5 months later, Lehman Brothers collapsed. While many call such events unforeseeable, the truth is different. With the right insights, analysis, and most crucially, the right contacts, it's possible to see these momentous shifts before they happen. Over the years, our organization has included MPs, members of the House of Lords, ex-MI5, Soviet spies, and a former city fund manager. Today, our organization works in much the same way. It's comprised of leading financial and political experts the world over, many of whom prefer not to have their names known in public. Some do, and I'll introduce you to them in just a second. So what do you get when you become a member of the Fleet Street Letter? First off, you'll get immediate access to your special report, 3 essential stocks for your precious metals portfolio. That report includes the full details on the ideal gold miner and my gold skimming play. You'll also get access to one more opportunity I'm yet to tell you about. And boy, it is a humdinger. Now, you'll notice the name of your special report isn't the essential gold stocks for your portfolio, but rather 3 essential stocks for your precious metals portfolio. And that's because the third investment opportunity I want to send your way isn't a gold stock at all. It's an investment into its little sister, silver. You see, silver also looks primed to soar for 3 simple but powerful reasons. Let me quickly run through them. First, as you may know, in a secular gold bull market, silver also tends to rocket. But much like gold miners, silver tends to move later and even higher than gold itself. As you can see from this chart, during the 1970s bull market, gold takes off first. But it's shortly followed by silver, whose gains spike right through the gold chart. This same phenomenon was even more pronounced in the bull market of the 2000s. While gold rose in value by more than 5 times, silver massively outperformed, rising 8 times in value. It's a compelling pattern, no doubt. But how is the price of silver tracking to gold right now? As you can see, silver is moving up. It's slightly lagging behind gold in keeping with the pattern. And that means the next step could be for silver to outperform in a massive way. This alone is a flashing green light to get some exposure to silver. But silver has another major tailwind in its sails that makes this opportunity all the more compelling. And it all boils down to the first law of economics: supply and demand. As you may know, the AI boom has created a massive shortage of semiconductors. As a result, tech companies are scrambling to buy up every chip they can get their hands on. Well, it just so happens that silver is a critical material in the manufacture of semiconductor chips. Silver is the best conductor of electricity on the periodic table. It enables semiconductors to be more energy efficient and creates faster processing times, ultimately leading to smaller and more powerful computer chips. As you can imagine, this situation has only one outcome: an explosive surge in silver demand. As Money Metals Exchange recently stated, silver demand could deplete global inventories as early as next year. Mining.com says that silver miners are struggling to keep up with demand. An international banker recently reported that silver is experiencing soaring industrial demand. And here's the best part. While demand for silver is skyrocketing, miners' hands are somewhat tied in their ability to produce it. What am I talking about? Well, as you probably learned in O-level economics, when the demand of something goes up, the supply usually rises to meet that demand. This brings the supply imbalance back into equilibrium and stops the price rising higher. But crucially, that isn't the case with silver. You see, despite silver's critical importance, only 2 mines in the world exist solely to produce it. And there's a reason for this. Silver is usually produced as a byproduct of other metals like copper, zinc, and lead, which have markets that are far larger than the one for silver. The market for copper, for example, is 33 times larger than that for silver. That means, unless silver were to rise to truly astronomical levels, the supply will remain somewhat capped, and the price only has one way to go: up. This is terrible news for the likes of Apple, OpenAI, Nvidia, and Microsoft, but it's great news for precious metals investors like us. As Crux Investor states, surging industrial demand and constrained supply set stage for silver bull market. Investing.com echoes that sentiment, saying silver is set to soar. While Kitco says the coming silver bull will be like the 1970s. In your special report, 3 essential stocks for your precious metals portfolio, I've identified what I believe is the perfect silver stock to capitalize on silver's coming surge. It's UK listed, so you can buy it with just a few clicks of your mouse through your brokerage account. And it flies through my 4-point checklist with flying colors. That's all I can say about this company for now. Revealing any more details could compromise the opportunity for our current members. But I'll show you how you can get your hands on that report in just a second. As you can see, my aim in the Fleet Street letter is to get you ahead and profiting from the most lucrative and impactful changes taking place in the world today. And it doesn't stop with this report. Over the course of the year, we'll send you 12 issues of the Fleet Street letter. In these monthly reports, we'll dive deep. The financial world moves fast. New trends and threats develop. Old ones die. There's no one single set and forget approach you can take to thrive in the modern financial world. That's why our monthly deep dive reports are so valuable. They're your way of staying up to date with the latest thinking, ideas, threats, and opportunities. That might be a new risk developing, a new money-making opportunity, a new position for your portfolio. It depends on what's happening in the world. But whatever is going on will be there, on your side and in your corner. You'll also get a copy of our newest report, What to Do with Your Money Right Now. This report does exactly what it says on the tin. It shows you, in specific detail, the exact stocks you need to avoid like the plague as the shift away from the dollar and currencies around the world continue to be devalued. The only FTSE 100 companies you should even consider owning in a crisis of confidence. The exact asset allocation strategy we're recommending all serious investors use right now. How much of your portfolio should be tied up in property and other real estate. But that's not all. There's another report we prepared for you. It's called The Trade of the Decade. Inside, you'll learn about the world's most essential industry, the one on which all others depend, and in which the world has chronically underfunded and poorly managed for decades. That industry is energy, and we have 3 specific recommendations for how investors can profit from both turmoil and transformational advances in the global energy economy. You'll get copies of all of these special reports as soon as you become a member of the Fleet Street letter. Each and every one of these reports are put together by myself and my esteemed colleague, Nick Hubble. You likely know Nick already from the interviews he's conducted for this very summit. Nick has an incredible track record of making big, controversial calls that turn out to be right on the money. As far back as July 2020, he predicted that a historic surge in inflation was coming. At the time, central banks were saying inflation was transitory. But Nick was right. Inflation soared to a 30-year high, with food and energy up more than 50%. In July 2020, Nick warned inflation would cause trouble in the bond market. He wrote, "The stakes couldn't be higher for investors, especially with the alternative, bonds, faring even worse." He was right. Bonds crashed into their worst bear market since the 1800s, with some UK government bonds losing 65% of their value in less than 2 years. When you sign up to the service, you'll receive a new issue from us every month, diving deep into the unforeseen forces shaping the world. You'll also get full access to the Fleet Street Letter portfolio. This is what really sets our work apart from the mainstream. We're not just here to explain what's happening, we translate that into an entire portfolio of investment ideas you can use to turn that knowledge into action. Generally speaking, the recommendations we share with you will involve the stock market. That involves risk, as all investing does. Some of our recommendations may be listed abroad. That may involve foreign currency risk, as stocks listed overseas may have the added risk of forex movements. And the funds we may recommend have a counterparty risk. Every recommendation is for your risk capital only. That's money you can't afford to lose. We'll explain this to you clearly with every new recommendation. In fact, every single idea we share with you will contain a full write-up of the potential risks and rewards, everything you need to know to make an informed decision and take control of your wealth. That's huge. Think about it. You could pay £700 for a subscription to the Financial Times, but nowhere in those pages of news will you find a single investment recommendation. It's all fluff, all noise. It doesn't matter how many PhDs the editorial teams have. They're not sharing anything you can act on. The Fleet Street Letter is different. You'll walk away from almost every issue with a fully researched investment recommendation that ties into our worldview. And you'll be in good company. The Fleet Street Letter has a committed readership of serious investors, some of whom have been following our work for decades. And in that time, we have received messages of appreciation for our work, like this note from James Muir, one of our longest-serving members. "I regard it as my investment Bible." Or this note from Barbara, another satisfied member. "I know I am with an excellent group of experts giving advice to me to then reflect and make my own decisions. I also appreciate and understand the relevance of the historical perspective and intellect documented of previous major historical events and their overall relevance on today's world. New investors most certainly try it. It provides independent, forthright information, a sound basis for investment." Our inbox is full of such praise for our research and recommendations. It's well written, it's easy to understand, it's not over-adventurous, and it talks sense. Of all your titles over about 15 years, the Fleet Street Letter is my favorite. It does the research that I'd never have time for. I based my mortgage decision on the Fleet Street Letter's forecast, and it proved to be remarkably accurate. It makes me feel incredibly proud to get this sort of feedback. These investors now have a jump on the rest of the market. They are getting my regular intelligence and insight on the deep changes happening in the world today, and how to position their money to profit from it. Now, it's your turn to become part of the Fleet Street Letter. The cost? It's not cheap. This is serious research and market intelligence designed to help you make good decisions with your wealth and savings. Quality research doesn't come cheap. That's why a one-year subscription to the Fleet Street Letter costs £249. That's a fair price for a team of world-class financial analysts sharing their most valuable ideas and investment recommendations. But today, you can get your first year for as little as £99 as part of a special introductory offer only for Gold Summit attendees. It's fully endorsed by my 90-day money-back guarantee. So if you don't like what you see, you can simply call our customer service team anytime in the first 90 days and we'll refund every penny you paid. Now it's worth noting this is triple the standard guarantee period we offer on our services. And it's a testament to just how much confidence I have that you'll love the Surface when you try it. Just click on the button to get started. It really has been my honor to host the Southbank Gold Summit 2025. I hope I have shown you how serious I am about helping you understand why now looks like such a great time to get into gold and into the right gold stocks. I just hope you can see that now is the time for action. Gold is experiencing its best year since the 1970s. Central banks are reversing a 50-year trend. They're once again the biggest buyers of gold on the market, driving gold demand higher and higher. Governments around the world are returning to their agenda of currency debasement. Geopolitical events are threatening to send trillions of dollars into gold at a moment's notice. And all this while gold stocks, trading at historically low valuations, are just beginning to embark on a rapid and steep rise. We're slap bang in the middle of a perfect storm for the gold market here. This is a situation gold investors have been dreaming about, and it's one you can put yourself in today for what amounts to just 27 pence a day. Investing in the right gold stocks could be the most lucrative decision you ever make. Don't be left wondering. Join the Fleet Street letter and get the names and ticker symbols of my top gold stock picks today. Click the link to take up your 90-day, no-obligation trial to the Fleet Street letter. I've done what I can to bring you in on this opportunity and in a way that works for you. I've taken £150 off the price of a membership, and I've taken all of the pressure off your decision by extending the usual 30-day money-back guarantee period to 90 days. Now it's over to you. Don't leave room for regret. Grab this opportunity with both hands. Click the link below to sign up to the Fleet Street letter and get the names of my top 3 stocks for the new boom in gold.